futures now. I'm Jackie DeAngelis. We are coming to you live from the commodity desk at CNBC Global Headquarters. Here's what's coming up on today's show. Bonds breaking out as turmoil in Europe escalates. Can we see an even bigger rally ahead? Invesco's Christina Hooper will be here to weigh in. Plus, crude oil tumbling to its lowest level in over a month. But one of your traders says that the sell-off may have gotten so bad it could actually be good. We've got that trade for you. But let's go ahead and start with the markets reeling from events across the pond, with the Dow sinking over 400 points at its lows and falling below its 50-day moving average today for the first time since early May. Scott Nations and Brian Stutland are your traders today. They are breaking down the day's market moves. Scott, let's go ahead and start with you. It seems like the Europe story is a little bit old, 3-4 years ago. It's resurfacing here, even though it seems like things have gotten better.
They certainly have gotten better, and it seems like the ECB, the European Central Bank, really is on the case over there. I think the problem and the reason our stock market is getting torpedoed is not because it's going on, but because it is such a surprise. We really thought that things were much better over there, and the fact that Italy is having a tough time refinancing its debt indicates that maybe things are not as good as we had hoped.
Brian, what are your thoughts?
Well, I don't know if it's so much a debt issue. When you look at the Italian bonds trading at 1.75% on the near term, it's not like we were back in 2010 and 11 when we had Italian bonds, Spanish bonds, Greek bonds trading above 10% and whatnot. So I don't think it's so much a debt issue as it is the uncertainty within the government right now poses a problem that Italy may leave the EU. If they leave the EU, who's the next one to fall? Having said that, I don't believe they can do that. When you look at it, listen, Great Britain could leave it because they didn't need Germany and the rest of everybody else to go leave, right? I think Italy, in this case, needs Germany. They need the greater good of the EU to exist as they do. Otherwise, there would be hyperinflation potentially. So I think things will sort out, but it's definitely freaking the market out right now.
All right. With markets tumbling, our next guest has identified a couple of key levels that could signal whether there's more trouble ahead of us. Master of the charts, Ralph Akampora of Altera Capital Partners, joins us by phone. Ralph, always great to have you, especially on a day like today, to get some context here.
Hi, Jackie. Thanks for having me.
Talk to me about what you're seeing in the markets, the levels that we're watching at this point, and which levels are going to start to concern you.
Yes, I think we should take a look at the S&P 500, and you stare at that graph, and you'll see that the market has been in a well-defined trading range for the last 5 months. But if you stare closely at the most recent activity, you'll see that the chart is labeled the 2,700 level on the S&P 500, which right now we're below it. If we close below that, then I can safely say that, again, we witnessed another failed rally. The rally in May just didn't follow through to the upside. And I think if you look back in the last several months, you had 4 or 5 other instances where that happened. And the market doesn't like failed rallies. Okay, but if I had to zero in on a very, very important level, you'd have to look at the February and the April low in the S&P 500. Well, the February low was slightly lower. It was at 25.32. That, to me, is the floor on this market. I'll give the bulls the benefit of the doubt that we're going to continue in this trading range, but I really have to stress to everyone, you have to be stock and sector specific. There's a lot of rotation going on, and there's damage being done, and some of the leadership is losing its mystique. For example, if you look at a chart of crude, yes, I heard the commentary before about, yes, on a short-term basis, you're getting a little oversold, and it might be a nice trading rally. I have a little trend line in there, and granted it's a very short-term uptrend, but I think we did some damage on some of the, well, not some, all of the energy-related names. I'm not saying it's permanent, but the talk of Saudi increasing their oil production, I think it provides a headwind to a leadership group that has been part of the recently movement to the upside. So crude, again, be very, very stock specific when you're looking at that. And again, this morning, the concerns at the European Union, global rates moving lower. And look at the Dow Jones Utility Index. I have a picture there. It's very, very short-term up move. As rates go down, the leadership becomes a little bit more defensive. And I'm not saying that the utility is about to take off, but we labeled the chart with a little number called 711. 711, if the Dow utility closes above that, then I think you have a market that's really very, very defensive.
Ralph,
that's what I see.
What do you think the chances are that we enter bear market territory and quite soon?
Well, I'm not predicting it, but I'm telling you I'm watching carefully because, as I mentioned a moment ago, failed rallies is an anathema to the stock market. That's it. You're starting to see more and more churning and tops being formed in some big-name stocks. And I'm fearful that if we do break down, you're going to have the beginning of what would be a major downtrend, would be a bear market. What would cause that? Well, you start losing more leadership. And today, the financials are under pressure. Again, you can relate that to rising interest rates and things like that, whatever the cause might be. But you don't want to see the XLF, for example, to make new lows. That to me, would be problematic. Now, having said that, there's a group that is still holding up very well, the technology. And then it gets back to the point that I was making before. Be very, very selective. There are areas you can be in. But the key areas are starting to get fuzzy for me. And I just want to give everybody a heads up, that's all.
Okay. Scott's going to jump in.
Right, Ralph, it's Scott in Chicago, and I have a question about this trading range that you pointed out in the S&P. If we were to get back above that trading range or break out of it to the upside, given your overall cautious tone, how would you approach that? Would you just say, you know what, I'm not going to participate, I'm not going to try and catch that, or is there a way in particular you would try to participate?
Are you saying to me that the S&P goes to above its January high of 28.72? If you're talking that way, then I'd say, you know, all bets off. You're off to the races again. Yeah, all-time new highs, fine. There's no problem with that.
Brian's going to jump in, Ralph.
Ralph, so to reach back on some of the leadership in technology, is an area that you're looking is the FANG sector, Facebook, Apple, if you throw that into the FANG as a plus, Netflix, Google, Amazon. Those types of stocks have really been the leaders. Seems like if those continue to move higher and act as the leaders, we're going to get a lot of back and forth trading in the S&P and the major indexes because we may see some sectors fall off the table. But I don't know that we get a significant sell-off in the S&P if we get that big, huge leadership from technology. Do you see it that way as well?
No, I agree with that. I'm not, guys, I'm not screaming bear call here. I'm just saying heads up because you're right. You can point at technology. There aren't that many sectors that look as good as technology. So the number of sectors that are look strong, a lot less than what we had a couple of months ago.
Ralph,
I think you'll agree with that.
Always great to have you. Thank you for your insight.
Thank you.
We'll talk to you again soon. We're going to get straight to the trade out of that interview. Scott, you're trading Dow E-minis for us. Are you a buyer or seller?
I want to be a little bit of a buyer, but a cautious buyer. So I want to be a buyer of the June contract in the Dow E-mini, that ticker symbol YM. I want to be a buyer at 24,350. That's about 50 handles above where the market is right now. So this is a stop-in trade because I want to see a little strength. We've actually had a pretty ugly 10 minutes right now, and I don't want to be trying to buy into that. My target to the upside would be 24,500. My stop to the downside would be 24,250. Again, I think that the Italy news should not be that big a surprise, and I think it's transient. I don't think that this is really going to unwind much of the good that's been done over the past couple of years. I also think that generally the equity market here in the United States has done pretty well as far as earnings are concerned. Interest rates are now lower. That's also good for stocks.
Okay, Brian?
Well, I think to Ralph's point earlier, you know, if you're looking to jump in, and I see why Scott's being cautious here, because a close below 27.10 on the E-mini, which it looks like will happen today, will be bad technically. Ralph pointed out the 2,700 level even. We're getting volatility starting to spike, so you've got to be very careful getting in this market. I still have some long bias in the market myself, but ultimately I have some hedges on that will protect myself because we've seen volatility. The VIX get down to very low levels, down below 13 earlier, just a handful of days ago. And so now we're seeing that spike and turn around, and people might freak out a little bit. So I agree, being cautious. I would not allocate all in to Scott's kind of trade here. If you want to start to dip in and price average in, I think maybe lower levels will come your way again, and you want to have enough bullets to do that.
Okay, Scott's buying the Dow futures, though, right now, 24,350, targeting a move up to 24,500, risking 500 to make 750 in this trade. Each point is worth $5. Meantime, bonds also moving on the political turmoil out of Italy. Let's bring in Christina Hooper, Chief Global Market Strategist at Invesco. Christina, always great to see you.
Thank you.
A little bit of a flight to safety today.
There is, and it makes sense. We certainly have an awful lot of political turmoil, but we have to keep in mind the old Benjamin Graham adage that in the short term, markets are a voting machine, but in the longer term, and this is particularly true for the stock market, it's a weighing machine. And so it makes sense that there's a flight to safety. There's a lot of fear in markets, but I do believe that it is overblown and that markets will calm down in the next few days.
Okay, and what do you think, what's sort of the realization that's going to calm the markets?
Well, I refer back to a few years ago when the debt crisis was about Greece, and there was an awful lot of concern. The systemic stress indicator for Europe was at highs that hadn't been seen in years. Wasn't as high as the global financial crisis, but very high. And what we saw was some reassuring words, not even actions, but words from ECB head Mario Draghi. And that was enough to soothe markets, to take down stress, to help bring down credit spreads. And my assumption is that we'll see something similar if the ECB believes it's necessary to step in and provide some reassurance.
All right, if it's not Europe per se, do you see something down the line, maybe later this year, that could potentially fuel the bond market rally?
Well, there are a lot of different events that could fuel a bond market rally. Similarly, that's true for the stock market. But my expectation is that what we're likely to see is continued movement to the U.S., to Germany. Part of this flight to safety is a move to U.S. bonds, to German bonds. But at a certain point, markets will realize that now valuations look attractive in some areas of the market that were hit with contagion, that don't necessarily reflect all the risk that had been priced into them.
Real quickly. Oh, sorry, go ahead.
No, go ahead, please.
I was just going to say, before I toss it over to the traders, I'm looking at yields right now, 2.8%. The market was a little concerned about, the rally over 3% in terms of the yield. Where do you see yields finding a comfort zone?
I think yields, the 10-year U.S. will probably get back up to close to 3%. Okay. I don't know if we'll get over 3% in the next few weeks, but I do believe we're going to see yields go up in the next few days.
All right, Brian Stutland, jump in here.
Well, you spoke about the EU earlier and what's going on over there. How much will that bleed into the U.S. markets in terms of creating volatility in the stock market, creating volatility in the credit markets? Is that something to concern that's going to bleed into other areas beyond what's going on in Italy?
Yes, it's already bleeding into the U.S. stock market to a certain extent. It's impacting credit. And I expect that to continue in the very short term. But as markets realize that that concerns are overblown, I think we'll return to some quasi form of normalcy. Keep in mind, there's the potential for this situation to get better from here. There is a rumor that I like to believe because perhaps I'm an optimist, but the rumor is that the Northern League, the League, is actually agreed to the finance minister being the architect of Plan B, because they recognize that that would cause a calling of new elections. And that would give them the upper hand. They perceive that they're more popular. It seems to be borne out in recent polls, and that they could have an upper hand in forming a policy platform. Keep in mind that a big portion of that policy platform that's currently on the plate for the coalition government are elements that are anti-business, and the League is very pro-business, pro-growth. So they could be supporting this finance minister's appointment because they wanted to trigger this set of events that could ultimately give it an upper hand and be able to negotiate and perhaps win some reforms from the European Union. I agree with a previous speaker who said that, quite frankly, Italy needs the European Union more than the European Union needs Italy. And so cooler minds hopefully will prevail and enable Italy to stay in the European Union.
All right, Christina, great to see you. Thank you so much.
Thanks for having me.
We'll talk to you again soon. Meantime, Brian, you're trading the 10-year note for us. Buyer or seller? She thinks things are going to calm down a little bit.
Yeah, I'm a buyer here. The June futures. You look at the 120 10-tick level, looking for it to trade up to 121.14. with the stop down at 119.26. So when I'm looking here to buy it, I don't necessarily love bonds longer term, but I think because the yields went up so much to 3% and came back down, and all that flow, the issues in Europe leading to some flow of the U.S. dollar back to dollars here, that will ultimately lead to 10-year. I think there'll be some support. If you're looking to hedge a portfolio that's long stocks, to me it makes sense that the 10-year may provide some of that hedge right now, given what's going on. I don't love it long term, but I think a short-term trade, it might actually pay off, and we might get a little bit of a bounce a little bit higher, see yields stay below that 2.8% level for a little bit of a short time here, enough to give you a hedge against your stock position.
Agree or disagree, Scott?
Listen, it depends on what you think is going to happen in the next, say, 36 hours, because this isn't a futures now trade. This is a futures right now trade. And why is that? It's because the Treasury market is where everybody goes when they're terrified. It used to be gold, and now it's Treasuries. And so if you think that this is going to get worse over the next, say, 48 hours, then Treasuries is a great place to be.
Yeah, gold not moving actually much here. $2 move to the downside today. All right, guys, let's get the risk reward on this trade. Brian is buying the 10-year note 120.10, targeting a move to 121.14. Each tick 31.25, risking 500 to make a little bit more than 1,000. All right, final topic of the day. We're going to end the show with crude, seeing its 5th straight day of losses and hitting its lowest levels in over a month. Scott, when you make a move this low in just a couple of days' time, you wonder, is there momentum here to the downside?
I think that's a great question. It has gotten crushed, beyond crushed, crude oil, that is. And so I think it's overdone. But to your point, I don't want to jump in front of this and get run over by buying a bunch of futures. So I want to be long. I want to participate if the market rallies. But I want to do this by using options. And so I'm going to buy an August 70 strike call on the crude oil futures contract. When I put it together, I could pay $1.05. So 105 for that August 70 strike call. Since I'm buying an option, that is my max loss. That's the most I can lose. But we participate, because we're long a call, we participate if crude oil rallies back. And since we now know that 3 of the biggest producers in the world are going to get together on Saturday in the Middle East and talk about the fact that it's fallen so far so fast, I would expect it to find a floor once the general geopolitical problems in Europe come to an end.
Okay. What do you think of this trade, Brian?
Well, I think using an option trade right here makes a lot of sense. And the reason being, we talked about on the Fast Money halftime report, the 66 dollar level in crude was sort of the range that we broke out of a couple months ago, and that range between 60 and 66. So my first step to step in and buy would be right at this 66 and a quarter level in the crude futures market. And by using a call, that's a good way to sort of initiate your first step, have enough ammo available in case we fall below 66, then I've got enough ammo to rebuy again at $60, because I think ultimately over the course of the year, we're going to probably end up higher than $60 in crude oil, probably higher than the 66 level. But certainly this is a great way to dip your toe in the market here, given the sell-off. And if you're a little nervous about how quickly we sold off, like you made, the point you made, Jackie, using a call option is a great way to do it.
All right, Scott, risk reward on this trade?
Well, again, our absolute maximum risk, if we take it all the way to expiration and this option ends up worthless, would be $1,050. We participate, again, on the upside. Our break even on the upside would be $71.05. Again, if we take it all the way to expiration. But, if we get up to $75 at expiration, then we're going to make $3,950.
All right, guys, thank you. That's going to do it for today's show. Meantime, you out there, if you missed anything, relax. We are on demand. Find all the videos right here at futuresnow.cnbc.com. For the latest headlines and a sneak peek of what's coming up on the next show, be sure to sign up for our newsletter, cnbc.com/futuresnow email. You can find the link to that and real-time trade updates on our Twitter account, the handle there with the little blue bird or little white bird at CNBC Futures Now. Otherwise, we'll see you for our next live broadcast on Thursday at 1 p.m. Eastern right here, futuresnow.cnbc.com. See you then.